Welcome back. We've got this analysis report on Beyond Meat, and it's a really strong, bullish, contrarian take.
A very strong take, yeah.
It basically argues that the all-time low, around 90 cents, is just a massive mispricing, because of the big changes to the balance sheet and cost controls. So let's just dive right in.
Let's do it.
First off, the tone. The conviction here is just, it's palpable. The title asks, is BYND ready to explode?
Right.
And you see phrases like dead money and this being a buy the fear moment.
And that's the first thing we should probably talk about. That highly charged, sort of sensational language, it actually distracts from how strong the financial argument is.
So you're saying the energy, the almost promotional feel, is actually working against the analysis report's goals, even though the author clearly wants to convey urgency.
I think so, yes. Absolutely. When you rely on words like explode or you talk about a violent move upward, you're introducing a lot of speculative noise. And for a sophisticated investment report, which this is clearly trying to be, that tone can, it can really undermine the analytical rigor.
So the core weakness is that the emotional pitch doesn't quite match the gravity of the financial analysis. The story is good enough on its own.
The story is plenty strong. You don't need to shout it. The suggestion here is really to shift the communication style, move away from speculative hype and more toward, let's call it calculated conviction.
Calculated conviction. I like that.
Let the numbers, the financial discipline points, just let them speak for themselves. The focus should be on viability and valuation, not so much the velocity of the move.
Okay, but hold on. If you drop the explode language, do you risk losing that urgency? This is a stock that's been called dead money for a year. You don't want to sound timid about a potential 300% gain.
You don't, but you can swap the emotional language for precise, financially grounded language. It achieves the same urgency, but with more credibility.
So give me an example.
Sure. So instead of a title like, is BYND ready to explode, you could frame it with a question that focuses on the actual business. Something like, BYND, analyzing viability after massive debt reduction. Or even, Beyond Meat, can cost discipline justify a 4x valuation?
Right, it grounds it in the financials.
It grounds it completely. And you can replace an emotional phrase like, buy the fear, with something that points to the actual opportunity, like buying the deeply mispriced asset. It immediately sounds more sophisticated, but you keep that core message.
That's a great pivot. Elevating the language really forces the reader to take the financial fixes seriously. And, speaking of rigor, that brings us to the structure. The analysis does a fantastic job identifying the catalyst. The debt reduction, getting it down to that, $215 million range, and the cost cutting. It's very effective.
Oh, absolutely. It proves the immediate bankruptcy risk is off the table. And for a contrarian play like this, that's step one.
Right.
But for a thesis like this to be truly robust, really comprehensive, the analysis has to give proportional weight to the other big risks.
And you're talking about the revenue, the falling sales.
I'm talking about stabilizing the falling revenue.
I guess the defense here would be that the price, 90 cents, that super low price to sales multiple, it already reflects the drop in demand. So maybe fixing the balance sheet is all you need for that first big re-rating.
That's a logical argument, but look at how the analysis actually handles it. The weakness is, it nails the solvency risk, the debt fix. But the core business viability risk, the idea that revenue must stabilize.
It's just mentioned briefly at the end.
Exactly. It's tucked away in the conclusion under a generic risk high heading. And that creates a pretty significant analytical gap.
And why does that gap matter so much?
Because the market isn't just pricing this thing for distress because of the debt. It's because sales are falling off a cliff, seemingly with no bottom. If sales keep dropping 30% year over year, it doesn't matter how clean the balance sheet is. You're just left with a solvent shrinking business. The analysis spends 2 big sections on the debt fix and like 2 sentences on the business model problem.
So the reader is left feeling like, okay, you've identified the biggest risk, but you haven't really told me what success even looks like in tackling it.
That's it, exactly. So the suggestion is pretty straightforward. Dedicate a specific analytical section to stress testing that revenue stabilization idea. The report needs to explore what has to happen for the sales decline to stop. You have to give the reader specific, quantitative metrics that signal things are turning around.
So you're moving from just naming a risk to actually quantifying the conditions for the thesis to work. What would that look like in practice? What kind of metrics?
Well, you could add a whole section. Call it something like the necessary condition, stabilizing the top line. And in there, you can analyze the rate of decline. Is it slowing down? Is it going from down 30% to down 15%? Because that deceleration is tangible evidence of stabilization.
Okay, that's concrete.
Or alternatively, you could model out the minimum sales performance they need to hit. You could say something like, if revenue declines by no more than 5% in Q4, that signals a successful pivot and justifies a reevaluation. You're setting a clear benchmark.
That's so important. Because if the revenue is still falling at an accelerating rate, it suggests a product problem that no amount of financial engineering is going to fix.
Right.
Showing that the rate of decline is slowing is maybe the only way to really justify calling it a deeply mispriced asset.
It shifts the whole narrative. It goes from, we fix the debt, so you should buy it, to, we fix the debt, and here is the quantifiable evidence we need to see on the top line to confirm the business is viable.
That's the kind of detail a serious investor is looking for.
It addresses their skepticism head-on.
Okay, that kind of structural completionist is definitely necessary here. So now let's shift from the risk to the reward. Let's talk about the valuation section.
Okay.
What I like here is how clearly the massive upside is laid out. If the stock just gets back to a modest 1x sales multiple from 0.23x now, that implies a 4x return. It frames the risk-reward very powerfully.
The potential reward is clear, yep, and the simple math is compelling. But the connection between the catalyst, the balance sheet overhaul, and that aggressive 300% plus potential, it needs to be analytically tightened.
What do you mean by tightened?
We need to prove that the cleanup actually warrants such a big repricing.
So there's a risk that it feels like the report is just saying they avoided bankruptcy, so they deserve a 1x price the sales multiple now.
That's the weakness, exactly. The analysis presents the debt reduction and the extreme valuation as two separate facts. It implies that just avoiding failure is enough to get you a 4x move.
And it overlooks the other part of the story.
It overlooks the need to explicitly link the operational improvements, the cost-cutting, the focus on gross margin, to the reason why the market should give it a higher multiple. The debt was only part of the problem. The cash burn was the other huge part.
Right? So you have to show that the internal changes, that new focus on profitability, fundamentally changes the economics of the business, making that 1x multiple justifiable today in a way it wasn't before.
Precisely. The suggesting is to integrate those financial discipline points directly into the valuation model. The argument becomes the improved efficiency and the lower debt dramatically reduce the need for growth to justify a market-acceptable multiple.
Especially break-even is now a lot closer.
Exactly. It's a much more sophisticated linkage. It really connects the dots for the reader and justifies the multiple expansion based on operational improvements, not just wishful thinking.
Okay, so how would you phrase that? What's a concrete example?
You could refine the valuation section to explicitly connect the pieces. You could state something like, given management's clear shift away from growth at all costs toward profitability, the new lower expense structure allows the company to reach cash flow positive with less revenue than previously required.
And that fundamentally changes the risk profile of the stock.
It does. If they can break even sooner, the risk of future dilution goes way down, and the company is seen as sustainable.
Right.
So the argument continues. Therefore, a successful stabilization of revenue combined with this new, more profitable cost base structurally justifies a baseline 1x PS multiple. Why? Because the company is no longer burning capital just to exist.
It transforms the valuation from simple math into a real economic justification. It turns a statistical observation into a cause and effect story.
It proves that the cleanup fundamentally increases the value of every single dollar of sales they make.
That's powerful. This has been an incredibly insightful discussion.